Hey everyone, and welcome to this explainer. I am absolutely thrilled you're here with us today because, well, we're going to unpack something that is affecting literally almost everyone who's trying to save and grow their money right now.
All right, moving into section 1, the 5% illusion. Why safe isn't always what it seems.
You know, Brian actually calls this mainstream narrative economic theater, and this brilliantly illustrates the massive disconnect between that narrative and the actual math. On the left, we have the Wall Street promise, this beautiful, untouched pie yielding a totally risk-free 5%. It sounds absolutely fantastic on paper. But then, on the right, we have the CPA reality. Basically, the IRS invites themselves to the party and takes a massive bite first. By the time that tax bill is paid, you aren't left with the robust return you were promised. You're really just left with the crumbs in this current economy. The core issue here is that everyone is rushing in and celebrating a safe yield, but it's incredibly easy for us to just forget the government's hidden tax cut. High interest rates create this sort of blind enthusiasm. When rates jump, our immediate reaction is to lock in that yield as fast as possible. But we have to remember that the government always takes its cut before that money actually hits your bottom line. It's a quiet siphon on your wealth. Which brings us to section 2, the hidden tax drag, the silent squeeze on your interest income. Now, take a look at this number, 35%. Just let that sink in for a sec. That is the massive federal tax trap waiting for your so-called safe interest income. A 35% cut of your yield is a staggering amount of your future wealth just quietly slipping away. This is the piece of the puzzle that almost always gets ignored until tax season rolls around, but it fundamentally changes the nature of your entire investment. So here is what tax drag actually means for you. It's the portion of your returns that is quietly siphoned away before it ever even hits your pocket. This is exactly why your purchasing power isn't growing the way you think it is. I mean, a 5% gross yield doesn't mean you can go out and buy 5% more goods next year, because that tax drag reduces your actual functional return significantly. So the crucial point is really the math. Let's look at section 3, the negative return reality, the math of the squeeze. Let's walk chronologically through the life cycle of a dollar invested in one of these supposedly safe T-bills. Okay, day 1, you make the investment, locking in what you think is a great 5% yield. You're feeling good. But then, tax season arrives, and the IRS takes that 35% cut we just talked about. Your return has already shrunk dramatically. But wait, the squeeze isn't over. Brian's analysis points to a projected 6% inflation rate hitting by 2026. When you factor in the rising cost of living against your already taxed returns, you reach a rather grim year-end reality. You haven't grown your money at all. You are actually looking at a negative 2% net loss in true purchasing power. Now, what's really interesting about this slide is how it visually plays out the trap. That first tall bar, that's the Wall Street promise, your 5% gross yield. Looks great. But then look at the second bar, the heavy downward pressure of the squeeze. That is the combination of taxes and inflation just relentlessly pushing down your gains. Finally, the third bar shows the harsh reality, a negative 2% final real return. You started out thinking you were moving forward, but the math proves you are actually stepping backward. To understand why this is happening on a much larger macro level, Brian frames it this way. He argues that investors are, quote, losing purchasing power while the government prints more devalued dollars. From his perspective, the combination of high taxes on the yield and an environment where the money supply is expanding means the very currency you're earning is worth less and less. This macro view really highlights why simply chasing a high gross yield just isn't enough in a complex economy. All right, let's switch gears to the solutions. Section 4, building your wealth fortress, strategies to escape the trap. Let's move to this table and see how this builds a clear roadmap for your portfolio. The contrast here is honestly night and day. On one side, sticking with those 5% T-bills drops you straight into that 35% tax trap and results in a guaranteed loss of purchasing power. But on the other side, utilizing alternative assets is designed to achieve a protected net worth and keep the math highly favorable to you, and not the IRS. So what are these alternative assets? Brian lays out 3 specific building blocks for your wealth fortress. First up, he suggests looking at tax-exempt municipal bonds, which bypass that federal tax drag completely. Second, for those under specific income thresholds, he highlights utilizing the 0% long-term capital gains strategy to keep way more of your investment growth. And finally, tying right back to his concerns about currency devaluation, he advises owning assets that the government fundamentally cannot print. Ultimately, the entire goal of these strategies is to protect your net worth explosion. By focusing on after-tax yields and real purchasing power, you're designing a portfolio that keeps the math in your favor. This is all about making sure you actually get to keep the wealth you generate, rather than just handing it right back as a victim of the 5% illusion. The core takeaway here is that to succeed, you really have to look past the headlines and skip the economic theater. You need to understand the true after-tax, after-inflation yield of your investments. If you found Brian's insights on these hidden traps valuable, he definitely encourages you to hit subscribe for his channel, Hidden Tax, where he dives even deeper into keeping the math on your side. Which leaves us with this final critical question to reflect on today. Take a look at your own portfolio. Look at where you are putting your hard-earned money right now. Are you building a wealth fortress, or are you falling for the illusion? Thank you so much for joining me for this explainer. I really hope it sparks some great ideas for you, and I will see you next time.